Hi, thank you for joining me in this walkthrough of my fully integrated financial model. Now, let's set some scene, all right, because this is a recorded demonstration, not a live session, and there's a very good reason for that. In a live session, things either move too fast or rather slow paced, and very important details therefore risk being missed out. With this format, you've got full control. You can pause, you can replay, or you can skip ahead to whenever and wherever you want. So here's the thing in finance. We often struggle with recurring problems. You have overestimated revenues, underestimated costs, or you know what, it could just be unclear financial needs. At the very heart of this problem is the gap that exists between operational reality and then financial reporting. Without connecting these two, businesses cannot therefore meet the expectations of their investors, whether they are venture capitalists, private equity sponsors, or public market shareholders. Each investor, though, irrespective of the type, wants something slightly different. Venture capitalists demand clarity on growth and scalability. Private equity sponsors focus on operational improvements and efficiency. And then you have the public investors who want consistency and accountability. So whilst there might be these subtle or obvious differences, they all want one thing in common. They want projections that can be tested against outcomes. They want clear explanations of performance in terms of volume, price, and timing. Back in 2008, during the financial crisis, predictive and correlation-based models, they collapsed under scrutiny brought upon by pressure of the crisis. In contrast, a driver-based model that mirrored operations remained credible. That experience guiding a PE back through such financial turmoil was a career-defining moment for me. It established a methodology that continues to shape how I have gone on to create nested suite of models grounded in operational drivers, double entry discipline, transparency, and practicality in Excel. Now let's take a look at the Excel reality. For decades, finance teams have been promised that the next generation of systems would finally solve their challenges. Yet, when deadlines are tight or executives ask questions that go beyond just the standard reports, everything and everyone circle back to Excel. It happens before a system goes live, during the transition, or even after the system has been fully embedded. Because Excel is the environment where numbers are reconciled, validated, and ultimately made to make sense. This reality doesn't negate the value of systems. ERPs and EPMs excel at governance and transaction processing. But when it comes to planning and analysis and financial storytelling, they sort of do not always cut it. They kind of fall short. The opportunity lies not in resisting Excel, but in knowing how to optimize Excel and its add-ons. Because when it's properly structured, Excel has always rivaled and in some cases exceeded the output of advanced systems while preserving the transparency and flexibility finance professionals come to trust. And this is the philosophy behind my modeling. Not just another spreadsheet, but a nested driver-based fully integrated financial operating system. So here's what a model actually does. It takes your operational drivers, things like your employees, subscription services, transaction, capex, loans, and stuff like that, including your working capital, and then connects all of these directly to the fully integrated financial statements. They therefore outputs that include the following. That's your detailed P&L, your balance sheet, and cash flow. And along with this, you get your transformational impact report, a narrative that walks your executives through the financial effect of strategic decisions. And here is how it gets delivered, not through your local file sharing, but through Microsoft Windows 365 cloud PCs. This gives every user a standardized environment, instant trial access, and a clear pathway to secure enterprise deployment. The model is built in a nested layer setup. These you have the input models, you have the processing layer, you have the main hub, and then you have the output modules. Every assumption is connected into the integrated P&L, the balance sheet, and the cash flow statements. This particular methodology rests on the principles that are the following. Number one, driver-based foundations. Number two, full financial integration. Number three, dynamic scenario simulation. Number four, nested modularity. Then number five, technology integration with Power Query and Copilot. Now, with all of that said, let's now step into the model itself. So using this demonstration of my own version of my own credentials, hit connect. I have one which pops up with my name and surname. Enter my password, and then it takes me to my dedicated cloud PC. Business, 8 gigabytes, 128 gigabytes of RAM, and you see like that loaded and waiting for me. And then just to walk you through rather quickly, you have these ones here. These are the input models. I'll walk you through those in a minute. And then you have the detailed principal financial statements, and then you have these blue ones here being the monthly management or quarterly or annual management reporting packages. Here we have the navigation page. From here you can click to familiarize yourselves with the models, and then you return to the navigation page here. Temporary employees, return to the navigation. Recurring revenue model, that takes you back to the navigation page. And then you have the cost of subscription, then that takes you back. Services revenue, that feeds off your permanent employees. And then you have the transaction-based revenue, and that takes you back. And then you have your overhead model, and then it takes you back. And then you have your cash book, and that takes you back. Capital expenditure, return, loan schedule, and then it takes you back. This section here is the detailed principal financial statements. You click here, it takes you to the section on revenue, and you can see from here that you have your profit and loss, your statement of financial position, and cash flow. For the beneath, you have the others. Returning there, you now have these sections here being the one that takes you to your management reporting packages. Hit that, and then it takes you there. Hit that one, it takes you back. And then you have the one for the profit and loss statement, and so on. So you're the first input model. Enter contents like you would have for your company. You have your zoom in a bit. You have your employee ID. You have your resource name, your department, your company. And like you notice, as I go from column to columns, it highlights it, and that's just to help you with the presentation view. When you're sharing your screen at your company, that's exactly what's going to happen. Job title and the line type, and then the applicable days payment outstanding, your start date, and then your end date. You now come to the output sections here. You have the days 360, monthly basic salaries and wages, monthly bonus accrual, monthly basic salaries and wages, employers national insurance, bonus accrual, employers national insurance, bonus health, pension, recruitment cost, office equipment depreciation, VAT recruitment and office equipment cost, trade payables, any other cost, staff cost, headcount joiners, headcount leavers, headcount brought forward, and then your total line cost. Just to show you how the model responds dynamically before I then go to the detailed principal financial statement, I'm going to introduce a new line, and you can see everything will now populate all through the line cost. This person joins in January. For this particular exercise, I'm not going to just do this person leaving some point in 2025-26 actually, and then by doing that, we just pay attention, and then we can see what has happened right here. Expand, and you can see that's the month of August. If I hit that, change that to October, focusing on this, you then see that feed through. We now go to the detailed principal financial statement just to see exactly what we've done. Zoom in just a little bit. We then have the following. We have the total revenue here. That is feeding of professional services. And that's because we have these permanent employees here that are in operations, also delivering professional services. That's something I can toggle off. But before I do that, I come back to the detailed principal financial statement, and you can see the services revenue in line with when the person was also working for and with the company. Expand on the cost to see the personnel cost of services. You see the salaries, national insurance, and so on, the incidental cost. If I was to come here one more time to change that to 25/05/2026, and then by the time we've done that, go back to the model, and we've seen that everything has now shifted accordingly. As we scroll down just to see the whole thing, we see the profit and loss section, we see the statement of financial position, we see the cash flow position, and we see the headcount joining in May, and you can expand to see which one for which cost center, and you can see the other ones for human resources fed through from here. These two, one joined in January, the other one joined in March 2026. Go back, there's the one that joined in March 2026. You expand here, joiner in 2026, brought forward the year before. Just exactly like that, that's how the model works. The next one is the one for the temporary employees planning. Using the contents from your human resources information system entered into the model. And I zoom in just a bit. You have the employee ID, you have the resource name, you have the department, you have the company, you have the job title, you have the line type, you have the applicable days payment outstanding, you have the start date, you have the end date. And then moving to the calculated sections, you have the networking days, not days 360 like we had in the permanent employees version. And then you have the monthly cost as a consequence. You can expand to see that based on exactly when the person started. If I was to come back here and then change that just to give you a feel for it, focusing on March because that's the month I'm going to use. We'll focus here, and then we see that February and January have now got no cost whatsoever. Collapse that, monthly cost, monthly VAT trend, monthly gross trend, monthly cash trend, monthly payables trend, office equipment depreciation, any other cost, staff cost, headcount joiners, headcount leavers, headcount brought forward, and you wrap it up with your total line cost. The next one, subscription revenue. You paste on the contents like that, and you end up with your customer ID. Expand here just to see some more. Customer name, your revenue stream, your company, your line description, your line monthly unit amount, your line unit quantity, your commission payable, your VAT rate percentage, your line duration in months, your applicable days sales outstanding, your line type, your start date. Collapse that so we've got more room to the right. Here we have the end date, and then you have the net line amount, which is the straightforward maths of the units, rates per unit. And then you have your days in 360, your deferred days, your monthly recurring revenue, your monthly deferred revenue, your VAT amount, your gross amount, your cash receipts, your trade debtors, your customer count one, your customer count churn, and then you have your customer count brought forward. And like that, we can now go back to the detailed principal financial statement one more time to see the impact of what we have entered thus far. And we can see we have the gross subscription revenue feeding through using the same contents you have for your contract database. And then as we travel downwards, we have our cost of permanent employees. And then here we have the ones for the temporary employees. We can expand here to see that feeding through for the respective cost centers. And then that gives us our net income. Traveling down, we have our current assets driven off from the day sales outstanding and days payment outstanding. And then we have the cash flow. We travel further down. And then we now see we have the clients counts brought forward. We have the clients additions. And next one up, we have the subscription cost of revenue. We insert the data contents in there, and we end up with the following. We have the supplier ID, we have the supplier name, cost of revenue stream, the company, we have the line description, we have the line unit amount, we have the line unit quantity, we have the VAT rate, we have the line duration in months, we have the applicable days payment outstanding, we have the start date, and we have the end date, and we have the net line amount. And then traveling to our right, we have the days 360. We have the deferred days, we have the monthly recurring cost of revenue, we have the monthly deferred cost of revenue, we have the VAT amount, we have the gross amount, we have the cash payment, we have the trade payables. And then now we can take a look at the services revenue. And now we can see that off the back of what we have right here, we have this contents. You have this toggle button which can exclude or include, just to show you that executed, and that is now excluding the professional services resources. Alternatively, for this walkthrough, I'm going to now include that. We have the employee ID, we have the resource name, we have the department, we have the company, project description, start date, end date, rate per hour, applicable days, sales outstanding, and then the hours type. Traveling to our right, we have the days, networking days. We have the client hours in quantity, we have the order hours in quantity, we have the professional development hours in quantity, and we have the statutory holiday hours in quantity, and then we end up with our total hours. You can see that these are the two right here. There's nothing for them with regards to the total hours nor the professional services revenue stream, and that's because the model does not include those. Those ones go into the SG&A, whereas these ones are professional services team. The next one is the transaction-based revenue. Coming to the model, data section, get the data. And then I zoom in so that we can have a feel for exactly what we're looking at. We have the customer ID, customer name, revenue stream, company. The company here is for when you are a private equity platform build. So you would have various companies. In this case, I have used, I think, as many as 6 just to have sample data that is juicy enough. Line description, line monthly unit amount, line unit quantity, margin percentage, the VAT rate percentage, applicable days as outstanding, line type, effective date. And then traveling to our right, we have the product revenue, product cost of revenue, VAT amount, gross amount, cash receipts, trade debtors, count of your customers that you've won in the respective periods. Next one up is the overheads. And we zoom in just a bit. So we have the line ID, the supplier, the overheads category. Then we expand a little bit. We have the company. Once again, we have the line description. We have the net line cost, the invoice date, the VAT rate percentage, the effective start date, and then the effective end date. To our right, same layout, same content. We have the days 360, the deferred days, the monthly overhead cost, the monthly deferred cost, the VAT amount, and the gross amount. Next one is the cash book, and then you enter the contents right there. Keeping with the others. Here I'm going to zoom in just a little bit so we can read out some things. And this particular schedule, you have the type which specifies whether the funding is equity or a loan. The investment type describes the specific type of funding, such as the seed funding, Series A, term loan, etc. The amount that indicates the investment amount in local currency. The interest rate denotes the applicable interest rate for the loans. And then you have your tenor duration that specifies the duration or tenor of the investment, such as the term length for loans or the funding round for equity investment for revolving credit lines. So convertible notes, specific terms are mentioned. Walking through rather quickly, we have the ref ID, the provider, the debt or equity description, company, the amount, the effective date, is it loan or equity, rate, duration, repayment type, alternative end date, and then you have your line description. In this case, we don't have any of that, but just to have another one, I'm going to go for something that is everyday occurrence, a loan, local bank, freehold property mortgage, Innovate Limited. Amount is 1.2, starting way back in 2023. Loan amount and 5%, 360 months. And you have it amortizing. And then when you travel to our right, let me just zoom out just a little bit so we have a feel for what we're looking at. We have the recognized days. I always use 360, but this one is for 25 years. Cash inflow, cash outflows, scheduled payment, scheduled interest, scheduled principal, and then we end up with a closing balance. And you can see that slightly reduced on there, whilst this one has remained as it should be. For us to quickly come back here and then change that duration in months to something rather short and condensed, say 12 months, and then you say the model will just update automatically, and then we travel to see that over the number of recognized dates and so on. That's how the model does the heavy lifting for you. You don't need to do anything, just focus on your inputs and you're good to go. Next one is the capex, alternatively called the fixed asset register. Hit that, and then we walk through the contents, the fields. Here we have our ref ID, the supplier, the asset group, the company, the asset description, the amount, effective date, does it include stamp duty or not, alternative end date, line description. And then we zoom out a little bit, so we have the opportunity to now see the following: recognized days 360, capex amount, VAT amount, monthly depreciation, accumulated depreciation, and we end up with our net book value. So that was a quick rapid fire one line entry, and we'll come back to here just to collapse this a little bit and have a feel for exactly what we saw earlier on. It's not going to be any different from when we had a one line entry for the permanent employees. And you can see your actual live projections, prior projections, and you have your difference here. So the next thing now would now be your bulk entry. Your company, you would have 10, 100, 1,000 employees. It doesn't really matter. So I'm going to now clear the input contents. And once that's done, I'll get a notification that the workbook is now completely cleared out of from the input sections on these models here. And then once that's finished executing, contents clear successfully in the specified ranges. So we're happy with that. So we come back here, take a look, and now see our detailed principal financial statement is rather clean. Back to the navigation page. And I want to do the bulk import. I'll hit this one here. And so what it is going to do, or what it is doing right now, is that it is going to your repository. It's a dedicated workbook where you have entered your content for your human resource information system, for your permanent employees, your temporary employees, your subscription revenue, cost of revenue, services revenue is going to feed off whatever you got here, and then your transaction base, your overheads, your cash book, your capital expenditure, and anything for your loan schedule as well. And once all of that is done, data copying task completed successfully. So that means everything has now been imported into the model. And just quickly to show you what exactly that means, you can now see you got a robust model now showing you all the resources you've got within your company. And you can see the rows go as many as 140 something. This can be easily scaled up or down. Temporary employees done as well. Subscription revenue done as well. And you can see it has taken on number of customers that you have per transaction. Cost of revenue, the same thing. Services revenue is now updated. Transaction based updated. Overheads done. Cash book, capex, loan schedule that requires something else, so it has not been done in this instance. And then you now have your detailed principal financial statements updated as follows. Now, good opportunity now to take you through the management reporting packages. Jumping through, you have your executive, your cover page, then you have your executive overview here. How I've designed it is that you have your profit and loss statement, your balance sheet, your cash flow, your key performance indicators, services hours for the professional services, and then you have the subscription, and then you have your financial runway, which looks at your cash, total operating expenses, your financial runway, how long you've got. And you can set a model, prior year, your live projections, and always as you're doing your presentation, click on a particular cell. It will highlight that so your audience can follow along. And then you have your live projections, your year-to-year changes, and then your year-to-year changes in percentages. The next management reporting package is the profit and loss. that you can expand to see the detailed line by line over 5 years. And then you have the one for your balance sheet, you one for your cash flow, and you one for your customer concentration for the top 35, your key performance indicators. I'm going to stop here to walk you through these ones rather quickly. You have your categories as follows: the profitability ratios here. We've got the gross profit, EBITDA, return on equity, return on assets, net gearing. I think I skipped one. Liquidity ratios, operating cash flows, current ratio, working capital, free cash flow coverage ratio, cash runway, cash ratios. You have your activities ratios here: days payable outstanding, days sales outstanding, your debt ratio. You have your debt to equity ratio, your interest coverage, customers ratio. You have your total sales and marketing. You have your customer retention rate. You have your opening clients count. You have your client additions. You have your clients leavers, and then you have your closing client count. Customer acquisition cost, subscription revenue, average revenue per unit, otherwise short into ARPU, gross margin per unit, cross short into GMPU, percentage of clients added, percentage of clients churned, customer lifetime. And then professional services, you have your client hours utilization percentage, realization rate in hours. You have your headcount professional services, your revenue per resource, your cost per resource, contribution per resource, and then you have your contribution resource percentage, general business metrics, revenue growth, profit growth, and then you have your departmental headcounts, operations, network, cybersecurity, IT, research and development, headcount security, finance, marketing, sales, human resources management, general administration. Next one up is a very, very important report. Every other one is, but this one is key for transformation, and that's why the fitting title is there for Transformation Impact Report. Keeping on my usual profit and loss, balance sheet, cash flow, key performance indicators, same old like you saw for the executive report. Here you have your post-transformation, here you have your pre-transformation, here you have your impact year to year, and here you have your year to year percentages. Next one is another version of the transformation impact report, only that this time we go from pre-transformation to impact year to year, and then you have your year to year percentages and post-transformation. I'm going to come back to show you how this works, but before I do that, now let's take a look at the departmental P&L. Here, this is where you can, like I said, that you are your departmental budget owner for operations. You toggle here, you have your, if you're driving revenue in this area, you have the consulting revenue. Then you have your cost of subscription if you had that. Alternatively, in this case, you're looking at people generated revenue, and then the cost associated with that particular cost center. You then have the salaries, bonus, commissions, the whole 9 years, all the incidental costs, and then the recruitment fees as well. And then if you got temp staff, same thing. Promotional marketing, not applicable because that's not spread out based on anything. And then you end up with your contribution and contribution margin, your headcount levers carried down, your services hours, key performance indicators, and then you have your revenue, total resources, and so on. Here, very simple. Next one, network. Come to finance, the same thing. Your head of finance, your finance director, human resources. This is where you can do that. So just to do that, that's how this works. Now let's go take a look now at the transformation. And this is where you can now, if you are running the FP&A, you can share these to the respective budget owners, or if you want to have a dedicated fractional FP&A finance partner, business partnering with you, you can now have a dedicated tool like this where you can input your contents into the input section and it's all yours. You run it as you deem fit. So we now come back to here, and what I'm now going to do is I'm going to now move the live projections from here so you can have a feel for how the transformation impact actually operates. You move the live data from the live projections onto the prior projections, and then that's already done and executed. We now come back to here. Any one of them will do just fine, but you now have your pre-transformation and your post-transformation being exactly the same, and as a result you have nothing on the impact year to year. And you now go to argument's sake, you want to let go of some resources because you think you have something that is way too much surplus to requirements. Picking on any one of these, you just enter here. I'm going to use just one so that we can actually see that one just flowing through. So I'm going to pick a date that is after when this person joined the company. So in this case, I'm going to go 30/1/2027, and then when I do that, enter, and you're going to see the days 360 disappear. We now go back to one of the transformation impact reports. First one up is this one. So we travel from post-transformation to pre-transformation, and we see the impact year-to-year changes, and we have the percentages changes. We go to the other version, and you can see how this one interprets what you're looking at in this format. You had your pre-transformation looking as follows. You had your impact year on year, percentages year on year, and then the post-transformation outlook looks as follows. And just for us to have a feel, the best place is just, let's take a look at the total equity at the end of year 5. Pre-transformation, we had 185.9. Pre-transformation, post-transformation, we now have 186,408, and that's because we let go of one resource who was going to drive our balance sheet impact at 475. And if I take that, and that here, 186,408, and that is the saving as a result of letting this person leave the company as at when we decided. So that is how you can see that you make real business decisions using the actual drivers within your organization, and you just go into the respective input model. You enter what would happen. You don't need to do any predictive or any calculations, because as you would do with a real human being, because there's a face and a name to headcount and people cost, the person is going to be let go on a specified date, and as a result of that date, the transformation impact report would then fill the impact. And that's exactly how you can now read your information presented to you with regards to, if I make this particular decision, this is what's going to happen to my top line, my profit and loss statement, to my balance sheet, and to my cash flow. And you can see that right here. So that is just running all the way down from the impact saving in the P&L, balance sheet, and then the cash flow statement, all through the model. And that's how it works exactly. Next thing I'm going to quickly now do is generate the distributable management reporting package, and it's as simple as there's a command button for that, but for this one, just to show you how it would work, select that, Control P that, and then by doing that, we now have it looking as follows. You have the cover page, you have the executive overview, you have the profit and loss statement, you have the statement of financial position, or alternatively called the balance sheet, you have the cash flow statement. This can be expanded like we saw earlier, and then you have the concentration of customers, and then you have the industry key performance indicators year on year. That was page 1, that's page 2. And then you have the transformation impact report, fitting it into one page. And then the second version of the transformation impact report. And then you then have the profit and loss statement subscription. And you have the departmental P&L that you can easily distribute. And then finally, you have the cost center trend contribution statement, all ready for you to use. All you have to do is just drop your email, and this is all yours, good to go. So off the back of that, I want to step sideways and talk about a rather important dimension, being the departmental by-products. The beauty of delivering this model via dedicated cloud piece is that it's not limited to just finance. It becomes a tool for any other department. And here is how it works. Take your finance leader, for example. Say you are the head director or VP of FP&A who prefers strategic leadership over operational modeling. You can use the 14-day trial to experience another way of planning and analyzing the companies. Not everyone has lived through the crisis or built driver-based models from scratch, and that's fine. This particular environment now shows you what's possible. Say you're in sales or you're a leader in sales, you can enter your team headcount into the people planning model, load your contract database into the recurring revenue model, and add commissions. The model will then immediately produce sales performance reports for you, and you can use that to have a conversation with your CEO on your board. It helps you justify or reconsider adding that one next salesperson with clarity and confidence. If you're in HR, you can test headcount scenario model, permanent versus temporary staff, and see how your recruitment plans will impact your cash and your cash outflows. Operations can use service volumes, delivery costs, and capex plans to build dynamic business cases tied directly into the depreciation, working capital, and unit economics. Treasury can then model direct cash flows, loan repayments, and covenant testings, all with the assurance of double entry reconciliation. Other departments like marketing, product, IT, customer success, you can gain a sandbox where you can plug in your assumptions and immediately see the financial impact. Your executives and boards, you know what? Scenario planning becomes something at your fingertips with a transformation impact report, narrating financial effects of strategic choices that may impact sensitive persons within the same management teams when it comes to cost restructuring or company-wide reorganization. You end up with a balanced financial statement that reconciles bottom-up, top-down perspective. The power of this transformation impact report is becoming a clear narrative that bridges strategy and financial outcomes. You have your KPIs and ratios aligned to investor expectations. And the best part, nobody needs to know that you have got a fractional finance partner behind the curtain. Under an NDA, you have a tool that costs a fraction of hiring a full-time expertise, but delivers 100% of the knowledge, skill, and experience. This is FP&A. Not just a function, but as a service. Portable, fractional, and embedded in the everyday decision making of the business. This model has a history. It began way back in 2008 during the crisis. It then matured through years of running in parallel with official systems, always the trusted reference point when executives wanted the truth. And it has been validated as enterprise-grade independent reviews confirming that it is not a training template. It's a working FP&A system tested in real business and real boardrooms. Its philosophy is simple, very simple. Forecasts must be grounded in operational drivers. Financials must reconcile through double entry discipline, and Excel should be always elevated, not sidelined. There you have it. The driver-based nested suite of integrated financial models, grounded in operational drivers, double entry compliant, fully integrated across financial statements, delivering executives clarity, departmental by-products, and enterprise deployment. And with Windows 365, it's not only secure and scalable, but deployable today. I'm Hamilton Alogaga, an FP&A practitioner who has lived through the pressures of boardrooms, investors, and private equity sponsors. My defining moment came in 2008 when I proposed and delivered a driver-based system that carried a PE-backed build through crisis. That moment shaped my approach, practical, grounded, and relentlessly focused on clarity. This model is the outcome of that journey. It's not theory, it's practice embedded. For now, thanks for watching, and until the very next time, happy financial planning and analyzing your companies. Thank you very much.